Early, not wrong. The Hormuz timing problem. So timing is one of the big issues when a punter's trading like Friar's. The first tier is fundamentals. It's very hard at times, certainly times like the present, to nail down the timing when you've got a buffoon like Trump tacoing and nachoing and etc. So the Hormuz Divergence Model was built on a rigorous thesis. The Strait of Hormuz disruption from late February 2026 creates structural supply dislocations across helium, bromine, LNG, petrochemical feedstocks that will progressively constrain semiconductor fabrication, memory production, and by extension, the AI buildout that the entire market is currently pricing as though it will run uninterrupted forever. The thesis is correct, the market is not pricing it. How do we reconcile that? The answer and the central lesson comes from a man who was in the same position in 2005-2006, Mr. Burry. The Big Short fame, great movie. He was right. He was early. For 2 full years, his investors thought he was wrong. They were not stupid. They simply had a different time horizon. So it's structural correctness versus market timing. By the way, if you haven't watched The Big Short, you really should. The paradox, supply disruption versus rising markets. On the left side of this slide, you have the disruption. Qatar produces approximately 35% of global helium. That supply is now choked. In fact, it's no more. Iran destroyed the facility, and it will take 3 to 5 years after the war is finished and the area is ready to start rebuilding, so at least 3 to 5 years. Bromine exposure via Israel and Jordan is a secondary but real risk. South Korea imports over 70% of its crude oil through the strait. Fabrication facilities in Taiwan and South Korea are running on 6-week liquid helium buffers, and those buffers have a time limit. They evaporate. Helium evaporates in 6 to 8 weeks. On the right side, we have Nvidia posting $81.6 billion in quarterly revenue, an 85% year-on-year increase. Jensen Huang closed the earnings call yesterday with the words, "Demand has gone parabolic." The hyperscalers, Microsoft, Alphabet, Amazon, Meta, have collectively committed $725 billion in capital expenditure for this year, 2026. That is nearly double what they spent in 2025. Both sides of this slide are true simultaneously. It's not a contradiction, it's a temporal mismatch. The market's pricing the next 2 quarters. Friar's thesis prices 2026 through 2029. These are completely different analytical frames operating on the same ticker symbols. The Burry lesson, being early versus being wrong. Now, I'll go through the Burry story. In 2025, Burry identified that the US mortgage-backed securities market was fraudulent. His analysis was forensic. He actually read the loan documentation, which almost nobody on Wall Street was doing. He identified that AAA-rated tranches contained subprime loans that were essentially certain to default once the teaser interest rates reset. He then bought credit default swaps, essentially insurance policies that would pay out if those bonds defaulted. The structure was critical. He had defined risk. He could not be margin called out of a position because it only carried the premium cost. That is the Burry equivalent to our defined risk spreads. Now the timeline. 2005 he buys. 2006 his positions are underwater. His investors are furious. They are threatening to pull their capital, and some actually do. Goldman Sachs is ringing him to say their models price his CDs, credit default swaps, as worthless. For a full year, being right was indistinguishable from being wrong. 2007, the first cracks appear in the market. 2008, catastrophic collapse. His profit, about $800 million. Three things made Burry's trade work. First, his forensic analysis gave him genuine information advantage. He had done the work, the market had not. That is the C variable framework. Second, his structure meant he could not be removed from the trade by a margin call. Third, his conviction held because his thesis was not based on price action, it was based on fundamental analysis that had not changed. Thesis supported. 6 reasons the market is ignoring Hormuz. First, inventory buffers. Chip makers carry roughly 6 weeks of liquid helium. SK Hynix secured inventory before the disruption. The market knows this. It is pricing the current buffer, not the cliff edge when the buffer expires. Second, AI demand is price inelastic. When Microsoft has committed $200 billion in capex for the year, a 20% increase in chip costs does not make them stop buying it. It raises NVIDIA's margins. From the market's perspective, supply disruption is actually bullish for NVIDIA in the short term. Third, $500 billion in forward revenue visibility. NVIDIA has locked in orders for Blackwell and the new Rubin platform through to the end of 2026. The market trusts that pipeline over the supply chain. Fourth, the damage is downstream and invisible. The photoresist polymers, the fluoropolymers, and epoxy compounds that flow through Gulf petrochemical supply chains take quarters to propagate into fab output constraints. No major fabricator has announced a curtailment. Until they do, there's nothing in the earnings data to price. Fifth, narrative dominance. This is the Keynes animal spirits. The AI narrative is self-reinforcing. Every earnings call, every hyperscaler guidance update, every sovereign government AI announcement adds fuel. Burry faced the same thing. Housing looked fine until suddenly it wasn't. And this is the book, Extraordinary Popular Delusions and the Madness of Crowds. Covers this beautifully with some old, similar stories, true events. And sixth, temporal mismatch. This is the one we keep coming back to. Tech traders, tech analysis traders and short-term equity funds are pricing 60 to 90 days, often shorter. Friar's pricing a structural dislocation that runs through to 2029. These are not the same trades, even though they use the same data. The supply cliff. When buffers expire. This slide's about the mechanisms. It's not speculation. This cascade was documented in real time during the 2022 helium shortage in the United States. And the loss of Ras Laffan is orders of magnitude larger as a supply source. Weeks 1 and 2, spot prices surge. The industrial gas distributors, Air Products, Lind, Air Liquid, activate emergency allocation protocols, beginning assessing inventory positions. Force majeure language starts appearing in supply contracts. Weeks 3 and 4, allocation rationing. Customers are restricted to a percentage of their contracted volumes. Fab procurement teams go to high alert. This is when the financial media will start picking up helium as a story. Weeks 5 and 6, fab curtailment. This is the cliff edge. EUV lithography throughput is reduced. Hospitals begin rationing MRI operational hours. SK Hynix buffer is exhausted. This is the moment the market can no longer look through the disruption. Third quarter and fourth quarter guidance cuts. TSMC, Samsung, Micron begin reducing forward guidance. DRAM prices spike further. They are already elevated. SOX begins to reprice the structural constraint. Friar's been deliberately pessimistic about the timeline here. It's possible that emergency helium logistics from alternate sources, US helium from the Federal Storage Reserve, doubtful. Russian helium via Arctic routing, yes. Algerian production, possibly. Partially offset the Qatar shortfall. But even with partial mitigation, the Ras-Laffan physical damage means some impacts run through to 2029. Watch for the 3 catalysts at the bottom of the slide. When one of those fires, the market's buffer argument collapses. That's our signal. Friar's Hormuz positions. The SOX bear put spread is the direct Hormuz to semiconductor play. The thesis is helium shortage leads to fab curtailment, leads to SOX repricing. The structure is defined risk. It cannot be removed from the trade by adverse price action, only by expiry. This is the Burry CDS parallel. The EWY South Korea Index ETF is alongside the SOX as weights. We're waiting for the turn signals. The EWJ, the Japanese market ETF, we've got a long put, 3 contracts. The Japan structural thesis, Japan imports over 95% of its Middle East oil through the Strait. Its bromine and helium exposure compound that. The January 2028 expiry is correct for this thesis duration. It's not a 60-day trade. The SLV ETF, 4 contracts in the January 27 leap. Coal. Silver is a critical mineral thesis. 6 consecutive years of structural supply deficit. The Livermore principle applies here. The position is in drawdown, but the thesis has not changed. When there is nothing to do, do nothing. Gold bull call spread, the gold revaluation thesis. Bessett monetizing the asset side. Fort Knox audit as the signal. Judy Sheldon convertible bond. You need to research these yourself. Defined risk, clear thesis, matching expiry. And remember, Friar talked about the fact that some punters have already taken have bought substantial calls at $10,000, $15,000 and $20,000 valuation for gold. They've already got them for the December this year. Very odd, very strange, hence why Friar's upped the fundamental score of the potential of Besant. Doing it is quite high because it makes me think the Trumps are involved. QQQ long put leap, Mag 7 circular financing thesis, Nvidia lending to OpenAI, leasing from CoreWeave borrowing from Nvidia, the same circular vendor financing that preceded the Cisco collapse in 2000. The January 2027 expiry is appropriate. It comes after both quarter three earnings. Every one of these positions is doctrine compliant, defined risk, thesis matched expiry, sized for conviction of tier conviction. The question is not whether they are well structured, the question is the patience. Okay, the timing framework, when to act, when to wait. On the left, when to enter, the full signal stack, MACD histogram reversal, stochastic confirmation above 20, EMA confluence, the Kalur and or signal 2 confirmation from the algo, a visible catalyst, not the thesis, we know the thesis, we're following the thesis, now we're looking for a visible event. Strike and expiry matched to the thesis duration. Max risk defined before we enter, not after. And the 50% profit target preset as a standing order. That is it. All 5 boxes ticked and we wait. On the right, when to wait. Our thesis is correct, but the catalyst is not yet visible. The signal stack is not aligned. The infantry buffers are protecting the status quo. Mr. Burry waited 2 years. He watched his position show unrealized losses for 24 months. He did not exit because the fundamental analysis had not changed. He was not looking at the price. He was looking at the loan documentation, the details, the black and white. We are looking at helium spot prices, fab utilization rates, and the TSMC guidance language. When those change, we act. Until they change, we wait. Paul Tudor Jones said, "The best trades are the ones where all factors are in your favor, not some, all. So we wait." Finally, the signal dashboard. What are we watching? What are we waiting for? Red, highest urgency, helium force majeure declarations. If Air Products, Lind or Air Liquide formally declare force majeure on helium supply contracts, that is the single clearest signal that the buffer argument has collapsed. Friar is going to be watching and will post immediately to Discord. Orange, elevated and accelerating. DRAM spot pricing. High bandwidth memory pricing has already surged. Any further acceleration, particularly if accompanied by commentary about helium or logistics constraints, confirms the cascade is underway. Next, orange, also elevated, TSMC and Samsung earnings guidance. Next reporting cycle, watch the language around input costs, capacity utilization and logistics. Language about operational headwinds is the tell. Also with Samsung, we will watch the workers' strike from their semiconductor processing plants. Yellow, monitor, bromine allocation. 2/3 of global bromine production comes from Israel and Jordan. So major difficulty getting more. Not yet a shortage, but sitting exposed if the conflict continues. This is the secondary semiconductor input that almost nobody is watching. Yellow, monitor, South Korean energy costs. Already up 60% since 2020. Prolonged Hormuz closure adds a structural burden to the Yongjin semiconductor cluster, designed to be the largest chip complex in the world. It simply cannot absorb this. And green, pre-signal but actionable. FCX copper is the materials play that sits adjacent our Hormuz framework. The algo is showing MACD reversal approaching, stochastic sub 20 and 100 and 200A confluence at 58.41. When the signal fires, the call-pull spread structure is ready. Well, we'd be looking around strikes $62 to $68 with a July expiry. Thank you and good night.